Ready?
No. All right. I'm behaving.
Are you behaving?
Not really, but let's go anyway.
Okay. Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, low home inventory, major headwind in U.S. housing market. This is an article I read. There was some cool charts and data in here. I thought we'd just talk about it. This has kind of been a theme, right? This low inventory is actually causing problems because of what? You would think this low inventory would just cause home prices to keep going up, but it's kind of not.
Well, it's not, because the houses that are on the market, bless their hearts, are wallflowers. Because if they weren't, they would be snapped up.
Yeah.
You know, there's
they don't know what a wallflower is. Assume they don't.
Assume they don't.
If they're over 50, they know. If they're under 50, they may not know.
They're special. They're just these special homes that just need a lot of love and attention and money. And maybe they're not in a great location, and maybe they're functionally obsolete.
Yep.
And maybe they're just not to anyone's liking, which is why they're still on the market.
So the euphemism comes from an old saying where teenagers were forced to go to a dance, and you had to get like your dance card filled, and you had to dance with, like, boys would have to dance with girls. And back then they knew, I don't know how they had the technology, but they had a way to figure out the boys from the girls. And so what they did was they had some of the girls like wouldn't get picked. So imagine this. If you can imagine this, I just don't even know how. The boys would somehow know which girls are more attractive. I don't know how they figured that out, but they would all get danced with. And then the other girls didn't get danced with that much. So they were wallflowers. Mm-hmm. So that's kind of where that euphemism comes from. Okay. Wallflowers.
So the point is that there are all these homes out there that are on the market, but the inventory is not very high. The homes that are priced well, that are attractive and in a good location, in good condition, that are updated, upgraded, and so on, those homes are selling. Everybody else, not so much. So that's the issue. Does that about cover?
I think so.
Okay.
Let's go to this first quote here from the article. U.S. housing market continues to face strong affordability headwinds, including a low inventory of houses for sale, which, while up in April, is still well below pre-pandemic levels as fewer new sellers opt to list their homes. Down 21% according to last year, according to Realtor.com. So new listings are 21% less than last year. Monthly housing trends report. That's from the Realtor report. Additionally, while listing prices were up slightly, plus 2.5% in April, annual listing price growth has decelerated for 10 months in a row, delivered decline year over year by later this spring. So first of all, that the list prices are still higher than they were than year over year. I think we all know that the ridiculous June comparison is going to be less, and then everyone will be like, this is the start of the housing crash, right?
Right.
That was supposed to start last year. Now it was put off a year because of rain.
Right. So the issue is that people who own homes, who would normally sell their home and then purchase another home, are not selling them. They're not selling them for a couple of reasons. First of all, because there's nothing out there that they want to buy. And second, because they've got these amazing interest rates and they're hesitant to give those up.
Right. Here's another quote from the article. A lack of new sellers and homes for sale continues to limit buyers' choices and home sales. Many sellers are likely future buyers too, which may be why a majority of would-be sellers report feeling locked in to their current home because of low mortgage rates, especially younger homeowners, says Danielle Hale, chief economist for Realtor.com. But older seller buyers who are likely to have a smaller mortgage balance and built up greater equity are likely to report feeling locked in by a low interest rate and are more likely to report that they need to sell anyway. This likely means the older households will continue to play a prominent role on both sides of the home sale transaction this year. Juana, the first thing that comes to mind with this is, I call it the California effect. It's when you go to California to buy a house and you're getting this big old loan and you realize everybody else is paying cash because they're selling their house in the Bay Area and they're moving to San Diego. So when they sell their house in San Francisco, they get, they walk away with $1.5 million and they just walk into San Diego and drop, $1 million on a house cash. And you're like, where are these people getting all the cash from? And they're just moving equity
Right.
from one house to another house, right?
Right. So there's a lot of that. The other thing to unpack is kind of the end of the paragraph that you read, where it's talking about older home sellers and not being quite as locked in to their homes and being more willing to sell. And part of that is where they are in their lives, right? You know, they have more days behind them than in front of them, and they're understanding that there's more value in time than money. And so even though maybe they might not sell for, you know, the extra $30,000 they would have maybe gotten last year, depending on where they are, they're okay with that, because what's more valuable to them is selling and then maybe moving closer to family or to a different location or whatever is important to them. And because their homes are either free and clear or nearly free and clear, they're not so concerned about mortgage rates, because they're probably going to take whatever equity they have and pay cash somewhere else. But they are still subject to the same thing that everybody's subject to, which is lack of inventory.
So maybe they want to sell, but they have flexibility because they can sell, take their cash.
Yes.
And then they can just wait and for something to come on the market.
Right.
Which a lot of them have probably done, right?
Yes.
Okay. Here's a chart I want to throw up. Now, remember, these are all national numbers we're talking about. So no matter where you are, you can get a feel for this. I do have a chart that shows some metro areas that we can talk about. But, okay, so this is from the April 2023 housing metrics. These are national numbers. As you can see, that we have median list price change over April of 2022, which was a year ago, is up 2.5%. Now, you would not have guessed from the housing haters and the crash bros, both of those groups, that this would, like, they literally would have completely said we would be 40 to 50% lower right now. Not only were they wrong, they got the direction wrong, okay? They got the completely wrong directions. They're off substantially, okay? But when you look at the change over April of 2019, it's massive. Now, what I want to know is, where were the people who are making all the videos that so know exactly what's going to happen in housing? I want to see their 2019 videos where they predict housing would go up 36.5%.
I don't think you're going to find them.
But they know what's going to happen because they have all this information. They're super smart, and you would think they would have known this. I mean, how are they going to know prices are going to be crushed if they don't even know they're going to go up?
Well, so they've got really cool charts, lots of energy, and they talk really loud. So that makes up for it.
And they have really good thumbnails. They pay a lot of money to have their thumbnails done.
Yes. Okay,
next one's active listings. Now, there's more listings from April of last year, but if you look at compared to April of 2019, we're down 50%. Now, what's interesting is this is misleading. Change over April 22. This was like the lowest April ever in recorded history. I mean, the last time there were, if you look at April of 2022, the last time there were this few listings, the Pilgrims were still here. Okay?
Well, and the MLS was powered by gerbils.
And they probably don't even know who the Pilgrims are.
That's okay.
Because they probably went to public schools.
Yes, but they know gerbils in the MLS, so it's all
gerbils
good.
In the MLS. Okay, the next one's new listings. Now, this is really shocking.
Okay.
New listings are down 21% from last year.
Mm-hmm. Right, because, we've talked about this. People don't want to put their house on the market, because if they put their house on the market, that's great, and it'll sell, but then they're going to be homeless or they're going to be tenants, and they don't want either one of those because there's nothing out there for them. So, we've talked about this before. It's the chicken or the egg, right? If the sellers don't put their houses on the market, there won't be inventory, and if there isn't any inventory, the sellers won't put their houses on the market.
Okay. I believe that this percentage, the new listings one, actually is probably more shocking than up 2.5%. Like, if you'd asked, like, all the people would have assumed that, and what they said was going to happen was that everyone would try to sell, there would be no one left to buy, a bubble would build up and crash. Of course, none of that's happened, but this is really, really shocking to see the new listings down 21% from last year. Like, we just don't have, the people aren't panic selling. Like, all the people that watch the crash videos are not out there panic selling. And there's probably a bunch of realtors who made crash videos hoping they would get listings, aren't getting a bunch of listings. This is another good one. Median days on the market It's up 17 days from last year, which was probably the shortest time ever.
Right.
But it's down 10 days from April 2019. So it's still a hot market, right?
It is.
That's a good comparison.
It is a good comparison because you have to compare it to a normal year. Look, pandemic is over. It's like saying, well, I can't get toilet paper at Costco. Well, yeah, you can. It's not, 2021. So you can't compare the housing market in the same way to 2021, 2022. It's not the same thing.
Why didn't toilet paper prices plunge with the excess inventory of you would have thought that the demand of buying toilet paper would have made toilet paper prices skyrocket, and that all this massive inventory of toilet paper would cause you would be able to just buy toilet paper for pennies on the dollar.
Not so much.
Not so much. Amazing how that happens. Here's the last one. Share of active listings with price reductions. It's up 5.4% to 12.2%, which is down 2.2% from 2019. So this whole thing where everybody's having to reduce their price to sell, it's not happening, guys. It's not happening. We literally said the market would go back to a normal market after a adjustment, which is kind of what it did, right?
It did. And look, we're going to get through this spring, and it's a good spring for sellers.
It's been a good spring.
And then we're going to go into summer where, particularly depending on where you are in the country, it might be slow, but pretty slow. And then we're going to get into the fall, and then we'll see what happens. The fall, I think, to me, is going to be super interesting because normally the fall is the slowest time of the year. But that is left to be seen for this year because I think this year might surprise us depending on what happens with interest rates. I've said this a lot that my concern with the Fed policy is that they want instant gratification. They want whatever they do today to show up in the economy simultaneously, and it doesn't. The economy is complex, and it takes a while for all of their actions to show up in the economy. Same way that when they gave everybody money, it took a while for inflation to happen. The inverse is true as well. That with all these rate hikes, it takes a while for the inflation to moderate. Now, it was moderating pretty slowly, but now recently it's caught steam, and that concerns me, which, on the surface, inflation going down inflation is a good thing. But if you think about it, and if you understand what I'm saying, that the economy has a lot of momentum in it, the inflation going down quickly right now is a cause for concern, because if it goes down quickly and too quickly, then we're going to get into this vicious cycle where then the Fed then has to lower rates quickly, and we're just doing this yo-yo thing. And the yo-yo thing nobody likes, okay? Nobody likes instability. And that's my concern, is instability. So to kind of circle back, as far as this fall is concerned, we're expecting inventory to favor buyers. However, if interest rates do drop with, again, the Fed reacting too quickly as far as raising interest rates and not letting things play out, then we could see a fall that resembles more like a spring buying season. Now, I'm not saying that the fall is going to be that way, but I'm saying that is a possibility depending on what the Fed does.
I found this awesome chart.
Ooh, charts. I like charts.
But I don't have it right now. So you're gonna have to subscribe, and then I'll put it on another video. But it shows the trend of what's happening with inflation. This is what I think. I think inflation. The inflation isn't slowing down. It's like starting to disappear. We had almost a 1% decrease, not 1%, but like it went from like 6 to 5.
Right.
Like inflation substantially changed just in the last month. Remember, we were sitting at like 8% for quite a while, and then it kind of hit the 6s, and it just started shooting down. So I think the Fed, the Fed did this last interest rate hike, and I think we see inflation start to go away. I still sort of think there might be a soft landing. I think Jerome Powell, didn't he come out and said that there's not going to be a recession or something?
Well, I think he's still expecting a recession because that's what everybody always says. We're going to have a recession in 6 months. That's what we hear. And we hear it forever. And eventually they're right. But I don't know if that makes them right or if just makes it inevitable. But one of the things that he said was that he's going to observe what's happening in the economy and make future determinations based on observations rather than predicting future rate hikes. I think that's an unclear way to say what I just said, is that the economy is complex and the economy has momentum, and he needs to see how this thing plays out before he takes future action.
Okay. National median list price grew to 430,000 in April, up 424,000 in March. So it's going up again. Annual list price growth slowed 2.5% year over year. So that means that from April of last year, it was up 2.5%. So, of course, it went down in the fall. It's going to go down again this fall. Median list prices are going to start dropping in the summer, and then they're going to drop in the fall, and they're going to come back up again. And the way this has always worked historically is they drop a little. I mean, they literally drop 2 to 4% every year, and people don't make a big deal about it. And then they go up, 6-7%, and they kind of do this thing. It's like a sine curve, but it's kind of always moving up. So that's why home prices in aggregate tend to go up. Okay, so I found this cool chart. I put it together. Now, what this is this happens to be some metro areas, and it's the median list price, the year-over-year list price, and then the median list price per square foot. Now, remember, these are list prices, not sale prices. And that's got the active listing count and the new listing count year over year, median days on the market. So what's interesting about this, first of all, Vegas, right, 460, which median list price is above the national average. But the list price year over year is down 7%. The median list price per square foot's down 5.9 percent. But the new listing count's down 30. New listings are down 30% year over year. We have 30% less new listings than we had a year ago. New listings coming on the market.
Right. So that's 30% less choices for buyers.
Yeah.
That's the way I think of it.
The other stuff that's on here is everything on this chart, like Jacksonville, Florida was 0 for median list price year over year. But if you look at all these other markets, they're all up. And then Kansas City's 21%, Memphis 31%, Milwaukee 21%. So a lot of this doesn't make sense to the crash people who are just, they don't understand basic economics. And
well, sometimes I question whether the Federal Reserve does, because they knew a month ago that the producer price index was down. So that was an indication of the economy not continuing to have inflation grow.
It's a leading indicator.
It's a leading indicator. Well, no, this was the producer price index, which was really important, because the producer price index, we talked about this in a previous video. When it costs them less to make something, they have two choices. They can pass on the savings to the consumer, or they can pocket the difference. So, that's kind of what we were seeing, is we were seeing that the producers' costs were going down, and they were passing those savings on to the consumer, which again goes toward inflation going down. The other thing is, the price of housing has, for the most part, kind of stabilized.
Yep.
We haven't seen a whole lot of dramatic increase or decrease. So again, that is not causing inflation to go up. Stability is good, because stability and then price reductions as far as consumer goods is what makes inflation go down.
The CPI, Consumer Price Index, is an index of goods and services sold. But remember, these goods and services, they measure them at the point of sale. So first of all, it takes them all to gather the data. And some of these goods and services, there's a production, process to build these things. And it starts with raw materials and supply chains, and then you have to basically build something and then sell it. And then the government looks and says, what did that thing sell for? What's the value of it? What's the value to the total economy, right? The problem is remember, it's an index and it's looking at the whole economy. So there could be parts of the economy. You could have the CPI be 0, but you could have parts of the economy growing and having price inflation and parts having price deflation. You certainly do with technology over the years. Look at the price of a TV today versus the price of a TV 20 years ago, and then look at what you're getting out of the TV. Like the top of the line TV last 20 years ago would have been $6,000, and it would look terrible today. We couldn't even buy it today. And then you go to Costco for like $250 and buy a far superior TV to what you could have bought 20 years ago. So the PPI, Producer Price Index, is actually it's important because it's sort of a harbinger of what's getting ready to happen. So, but the bottom line is the Fed has strings to pull if they choke off inflation too fast and kill the economy.
Right. What my concern is, I don't want to see a yo-yo where they're raising interest rates and that's causing some issues, and then they're lowering interest rates. We like stability. Stability is good for the market. Stability is good for you and I because we can plan our lives around stability.
Right. So the other thing too is this: the two, and this is like a Vegas. If you're watching this not in Vegas, depending on what your market is. So let's say you're in Miami, you have an interesting market because you have some tourism and leisure that's associated with that. Like as cruise ships go out of there, and there's a big international airport there, and then you also have this like tech scene. So it's growing because you're bringing in like tech bros and all their startup companies and venture capital is starting to show up, and so there's wealth being created down there, right? And then you'll take an area like San Francisco, which is mostly tech, or you can have an area like Denver, which I don't know what's even going on in Denver today. I think it's just a bunch of people are just moving there. That's the thing growing the economy. They don't really have a defined thing, right? They have a little bit of everything, which is good. They're diversified. Of course, you get like New York City, of course, you have Wall Street, you have fashion, and then you have tourism like crazy because everyone comes to New York City and they see Broadway shows, etc. Right? Vegas, we don't have that sort of diversity. Vegas, we have leisure, hospitality, and construction are the main industries here. And the two biggest really are this hospitality and leisure. Mm-hmm. It's what Vegas is, right? Mm-hmm. So what's very interesting is despite the recession that's going to happen, our sector, and including travel, is absolutely exploding. Every single airline is hiring right now. Airlines are growing like crazy. Vegas is building. We have how many new casinos and things do we have? We have the Sphere going up. We have the Hard Rock's building a new one. Yeah. Fountain Blue's going to open, right? A bunch of them. So
there are a lot of projects going on in Vegas. To Todd's point, as far as the airlines hiring, yes, they're hiring. If you've been on a flight recently, they're all full or overbooked. If you've been into an airport, it looks like a refugee center. It's just full of people everywhere. It's standing room only. So it's a very busy time, and that's a good thing. It means that the economy's turning. It means that people have chosen to travel and to entertain themselves and live their lives. Look, people were cooped up for a couple of years, and they have a lot of steam to blow off. And I realize that they've already spent the money that the government sent them, but clearly they're not done spending. And certainly looking at the rising credit card debt, it's very clear that they're not done spending. So we'll see how that pans out in the economy. Yes, we are concerned about the rising credit card debt. We are watching that too. So for those of you who are watching that, yes, we are aware of that, and we'll keep an eye on it and keep you posted. Yeah. So what did you think of the video? Did you like the charts? Did Todd leave the charts up long enough for you to read them? Yes. Please give us some feedback on that, because that's important. We want to make sure that you are able to read the charts. Because we like them and we want to share them with you. So give us some feedback. We appreciate it. Any comments are welcome. You don't have to agree with us. Please subscribe, hit the notification bell, like the video, share the video, and we'll see you on the next video. Bye.
Bye.